TPG and TUA, which is the mobile spin-off in Singapore. So firstly, as you may be aware, TPG and Vodafone this week have consummated a merger that's been about 2 years in the making, so a very long journey to get here, but it's finally happened. So this transaction's now done, and we have just initiated coverage on the merged company, which trades under the ticker TPG. TPG consists of two key consumer brands, TPG Telecom, which I'm sure many of you know, which is the fixed line segment or the NBN reseller these days, and then Vodafone, which is obviously the mobile side of things. Both of those two key brands service the price-conscious end of the market, and they've got around 22% market share by number of subscribers in Australia. If you did follow our earlier recommendation and buy into TPM, the pre-merged entity, since then you would have received a 52-cent special dividend and around 60 cents worth of TUA shares, which is an in-species dividend as well. So I wanted to just make a comment on TUA, that in-species distribution after talking about TPG, because there's been a few questions on that one. But on TPG, we have initiated with an ad recommendation and a $9.12 price target. So 3 reasons we recommend buying TPG are, number one, you put Vodafone and TPG together, and this creates a company that generates really strong, very significant cash flow. This allows them to invest meaningfully in mobile and, in our view, collectively do a much better job of servicing their customers. Number two, this merger combines with the near ending of the NBN, basically means we've got a re-rationalised market for telcos in Australia. We've seen NBN prices stable for about 18 months, and we've seen this month, July, Telstra actually increase mobile prices on its 5G products. So we're starting to see the price turn here, which is a key thing. And obviously, if that happens and sticks, it will benefit all of the telcos in Australia, including TPG. And number three, you're backing the founder and chairman, David Teo, who has a very impressive history of value creation. He owns $2.5 billion worth of TPG shares. So I think his attention to detail is going to be very razor focused. And I do think, once again, this company will deliver really strong free cash flow. TPG do have very limited forward-looking guidance, so it's always hard to know what to expect from this company. So that's, I guess, the negative. The positive is they always exceed. They do an exceptional job, and we think that will happen once again, and the company should surprise on the upside. So that's TPG. We have an ad recommendation, $9.12 price target. Those 3 key reasons to buy in summary. Number one, the combined business generates very strong free cash flow. Number two, the competitive environment is improving. Prices are going up. And number three, you're backing a man with 2.5 billion reasons to make this deal work. Secondly, I just wanted to talk on TUA. So that's the Singaporean mobile business that was spun out of TPM. So if you bought TPM, for every 1 TPM share, you got 2 in... Sorry, for every 1 TUA share you've got, that was for owning 2 TPM shares. Consequently, you've got quite a few people wondering what to do with this small parcel. If you're not familiar with the company, just a quick 101. TUA is a startup, Singaporean-only mobile network. For about the last 12 months, it's been offering free mobile services to customers in Singapore. As it's built out its network, that network has just recently gone live, and they've started converting customers to paying. And they're now in the processes of obviously trying to ramp up paying customers to generate a profit. At last count, they had 7,000 paying subscribers and 400,000 free subscribers. Those 400,000 free subscribers, their free trials will end sometime in the next 12 months, and they'll either sign up to become paying subscribers or disappear off. But TPG, or TUA, has said they need 450,000 paying subscribers, near enough to become EBITDA positive. So we think that means you're probably a couple of years away before this company actually generates a profit. We don't formally cover it, but for those wondering what to do, I guess here's 3 points to consider. Number one is, in the short term, the TUA share price is likely to come under pressure. As you know, TPM was a top 100 stock. TUA is not. That basically means if you're a fund manager who owns TPM, you've got this TUA share, and you probably can't own it because your mandate probably says you can only invest in top 100 stocks. So consequently, we do think there'll be a bit of selling pressure in the short term on this stock, and clearly it's a bit of a rounding error for some of those shareholders as well. Number two, TPM has already invested around $500 million of cash Singaporean into TUA. It is a loss-making business, but today it's got about $175 million of cash, so the business is funded for the foreseeable future. And number three, TUA is trading at probably a 40% discount to book value. I think the book value is about $1.15 per share versus a share price of 74 cents. So there is an attractive valuation point here if you're prepared to take a long-term view and take the view that they'll succeed in Singapore. So in summary, if you continue to own TUA, you need to take a long-term view and be aware that it's obviously a higher risk profile business as a Singaporean startup. If you want to top up, there's probably no immediate rush given there's a bit of an overhang on this stock, but I do think the current price is attractive, so it'd be worth looking, keeping an eye on that with a view to top up if that's what you want to do. So that's TPG, add recommendation, 9 to 12 price target, TUA value if you're a long-term investor.